Hey guys, welcome back to the Capital Mindset Show. I'm just going to be giving you guys an update. We had two banks report today, and I just want to kind of cover some of the things that were actually discussed in those earnings reports and kind of talk to you guys about some of my thoughts regarding these companies. So the first one we're going to be talking about is JPM Chase, and JPM Chase is down 3.64% as of the filming of this video. It does appear to be cheap on a preliminary look at a PE of about 8, dividend yield about 3.71. Of course, that's not where you finish off, but just to go over some of the things that the bank has actually been reporting here, we did see that overall, some segments were down, some segments were up. We saw corporate and investment banking falling about 12% quarter over quarter, 10% year over year, and then as well as commercial banking actually rose in revenue by about 12% quarter to quarter, and actually on a year over year basis for net income, we did see a fall of about 30%. So all in all, what we can kind of determine from the banking earnings reports that we've been seeing is that yes, almost undoubtedly that we are seeing some sort of slowdown in the future. A lot of them are kind of planning out for this. The only one that I thought was interesting back when they reported was Bank of America, saying that the consumer was really strong, but I think the data was kind of showing otherwise, but they were kind of course, they're going to say that. And now, Warren Buffett is basically investing primarily in JPM Chase, Bank of America. So Bank of America and Citigroup, and I think I have Citigroup here saved for you guys. Well, there's Bank of America and there's Citigroup. So Citigroup's down 3.21%. A lot of these earnings today were actually bringing down the XLE because now basically all the sentiment's kind of negative. We do look really smart, I guess, because we were selling, the banks a while ago. And now I'm in the process of rebuilding my bank holdings because just like the industrials, I think the banking sector is going to have some interesting value, so to speak, with all the pessimism that's going to get priced in. But we do see a P ratio of Citigroup at 5.19. What's interesting about Citigroup is it constantly trades at below book value. But however, you should also note that trading below book value for Citigroup is almost a given. It should be because of the quality of the bank, especially after the Voyager Digital video. You guys can appreciate a lot the statement of counterparty risk. So Citigroup has a decent amount of counterparty risk, something that Voyager Digital had in excess. And I think now we see, okay, obviously they had a lot of counterparty risk, but at the time, remember, I got pushback for saying that about Voyager Digital. So yeah, and people were saying, there's never going to be, that's not going to happen. We're not going to have a problem with solvency. Well, now they're going bankrupt. So that's that. But I don't want to equate Citigroup and Voyager Digital. Those are two vastly different institutions, vastly different entities here, but Citigroup was the one position that remained in the portfolio of the banks. Back in the day when I made videos talking about selling the banks, I got some questions in there regarding Citigroup saying, well, why is Citigroup staying? Is there something special about Citigroup? And I had to keep saying, no, there's nothing really special about Citigroup. I mainly was holding it for the speculation that the new CEO would be able to turn things around. It's not necessarily my favorite bank. If we actually look at Bank of America, this is the one I've been building out recently. It's still a very small portion of the portfolio, but I'm trying to build out my bank holdings yet again. And yeah, JPM Chase. So what was kind of like a reminder of the banks? Well, you see the banks have actually underperformed the SPY over the year-to-date period. So why were they underperforming? Well, because we're going through the liquidity crunch, something that I've been talking about for quite some time. If you're new to the channel, you can comment down below and ask what it is, or come to another live stream, or just go back to old videos, or just ask us another subscriber. If you ask down below, either I or an old subscriber will actually be able to answer the question, because people have been watching the channel for a long time, at least this year, and a little bit of the tail end of last year, can very much answer that question. So I have full faith that they can. And we have discussions about it here and there. So JPM Chase underperformed the market. Same with Bank of America. Year to date, it has also underperformed the market, down 34.64%. Bank of America is trading at slightly more expensive on a preliminary look at a P ratio of 8.6. Now, what we are going to actually plug into the valuation model is actually, we're going to probably put in JPM Chase. Why not? And maybe another bank. But it's just going to be like a quick look to give you guys an idea. I also want to show you Morgan Stanley. Morgan Stanley reported earnings today. Now, with Morgan Stanley, we have a little bit of kind of rhyming here, because investment banking dropped 35% quarter over quarter and 55% year over year. So that sounds really bad. That's a big segment. It stood at about 1.15 billion. So with that dropping massively, what's going on? What's the problem? Well, 2021 was an exorbitant year. So it makes sense that it drops on we went from crazy good times in investment banking world to bad times, or just moderate times, especially during a liquidity crunch versus a liquidity boom. boom, kind of countering to one another. And remember this, and I've repeated this over and over and over again, so I'll repeat it here again because it's very important, especially every time we talk about banks, and that has to do with lending growth and versus rising rates. A lot of people, especially in the retail community, especially here on YouTube, think that rising rates was good for banks. I kind of remember back in January where I scoffed at those remarks, not in a nice way. I think I was nice. I don't know. You guys be the judge. Was I nice when I was like that? But it has a lot more to do with the relationship with lending growth and rates, not just rates, right? Rates alone are not necessarily good for banks. And hindsight's 2020, but we were saying that back then. And now you kind of see how the story's played out. Well, we had rising rates and banks didn't do well because that's not necessarily that easy. It's not so simple. That's actually the better way of saying it. So trading was actually down about 10% and actually rose 8% year over year. So we see a little bit more volatility, kind of makes sense. 10% down quarter over quarter for this year, and it's about $3.6 billion there. Commissions and fees dropped about 14% and quarter over quarter. On a year over year basis, it was also down 7%. Now, taking a look at asset management, it actually dropped 4%, similar to JP Morgan, not really much of a problem there. Now, something to talk about JP Morgan, to kind of talk about its quality, we can take a look at something like a measure, and it's not the only measure you should be looking at, but it's return on tangible common equity. So that came actually in at 17% versus 16% in the previous quarter and 23% from the quarter of last year. Remember that last year was really crazy. It's really, well, crazy in a good way. But return on tangible common equity is one measure that you actually might want to use for these banks. It's one of many that you might want to use to determine the quality. Now, something that I was saying, remember what I was talking about Citigroup. Let's go back to Citigroup. So we go back here. Citigroup will always trade it at below tangible book value because of the quality of the bank. And depending on bank to bank to bank, you might come with different conclusions. But for the most part, you cannot use, and that's kind of a message of capital mindset, you cannot take one metric and apply it like a blanket to all banks. While tangible book equity or tangible book value, is a good metric to use when it comes to financials because we can take kind of the liquidation value of a bank of its financial assets that are usually pretty liquid for the most part. It's a good metric, but you don't want to use it for every single one and say they should all, be the same, right? Because that's not the case. Every asset, every portfolio is of different quality, so it should be trading at different levels. Citigroup's going to be a little bit lower quality. Goldman Sachs, same thing. You might look at Morgan Stanley, kind of the same thing, but a little bit better than Goldman Sachs. And then if we look at JP Morgan Chase is sort of the cream of the crop, the bellwether. It typically trades at above book value. Same with Bank of America. So when you look at Citigroup, and you probably hear Jim Cramer say this, not to poke fun too much at Jim Cramer, but he likes to say sometimes, I've heard him say that, Citigroup trades at $40 and the book value is about $70, therefore it's a buy. No, not so simple, because you're making the assumption that it will return back to book value, that's where it should be trading at. Not necessarily, because it's a lot more complicated than that. There's a lot more that has to go into kind of the analysis to determine what the real value of the bank is. That doesn't mean that it's overvalued here. It very much well could be undervalued. And I think that Warren Buffett is making a calculated bet here that, yes, the bank is undervalued. I actually would say at these prices, I'd probably be leaning on more that it's undervalued. I actually believe that it is now lower than my original purchase price, or getting very close to there. But you guys can probably check out in the portfolio, because I don't know off the top of my head. I'm doing this video just off the cuff. So with that being said, with Citigroup, it may be cheaper, yes, but we gotta understand that the quality. That's basically what I'm trying to highlight. And with Morgan Stanley, we do have a bank that is of higher quality than something like Goldman Sachs. I believe that. And a dividend yield of 3.74%, PE of about 9.53. All right, so let's actually go over to the valuation model. And I've actually already done it to save time, and I've already took on the liberty of adjusting it for a financial institution. So something that I do is, I just basically go there and over there to that side of the model. I will let the model know, hey, I'm dealing with a financial institution, and it will change its way as it kind of overlooks this company. So if we look at the book value of this company, it's about just under $100. We look at the sales, it's up and to the right, pretty good. But estimates, I do agree with analysts based off of where we are going. We see estimates coming down, and then cash flows are pretty lumpy, typical for a bank financial institution. So oftentimes you might want to use net income, for example, to kind of gauge, and go figure. The thing that is supposed to be designed to give you a good idea of what's going on in the business, GAAP net income, actually works in this instance for the most part. Shares outstanding, continual decline, and something that Warren Buffett likes about the banking institutions. Now, one thing I actually want to highlight is kind of give a credit where credit is due to whoever this is, Ho Sun. I guess, what do we call him? Journalist. So this journalist did a good story back in about June 27th. So he said Wall Street layoffs likely ahead as two-year hiring boom turns to bust, where he's basically reporting that potentially we're going to see declining trading volumes. Of course, this is kind of more likely to be seen. And of course, you could have probably been, understanding of this when you kind of identify something like the liquidity crunch occurring as liquidity kind of leaves the system, for a variety of reasons, but not to get into that here. And we see that he is talking about it here, and I read through it a little bit, and I do agree that he called it really well, or he described it really well. It's pretty simple, basically. It's that, in the past 2 years, the banking system, or the banks, the investment banks in particular, had a lot of opportunities. And with these opportunities, they were able to go on a hiring spree. And as kind of the things have changed, we do see that now the banks are looking to kind of become more efficient, kind of cut off the fat, make sure that they can, adapt to the next condition of the market, which is potentially some sort of slowdown / recession, which we've been talking about, that the United States is more than likely in recession already. The government just hasn't announced it yet. So we've been talking about that for quite some time. At least that's what a lot of signals are actually kind of showing us. But yes, and of course you can find different opinions on that. And, that doesn't mean that, that's the answer and that's the truth. That must be true or anything like that. All right, so going back to the evaluation, I just wanted to give that guy credit because he did a good story, and sometimes it comes off that I just don't like journalist majors or whatever. That's not true. I think that there are individuals who are really good. So if we take a look through this evaluation process, this is just a preliminary look. This is by no stretch of the imagination the end-all be-all. I'm looking at this and I'm saying I'm probably actually going to be interested in building out my JP Morgan Chase position, just a starter position here, and so I can rebuild the position at much lower prices. So I'm actually really excited. I think that the prices that the market is offering me might even get better. And I think actually that they're going to get better for the banks, as in we're probably going to see some lower prices. If I look at, for example, the chart here, let me go back to JP Morgan, and this is kind of a chart, but we're actually approaching levels where we didn't see until after the March crash. So this is actually where we're probably going to see levels around here, and I'm going to be buying all the way through. So JP Morgan Chase, don't be surprised as you start to see that enter the portfolio. If you see the portfolio update in the corner and you see JP Morgan Chase, really don't be surprised. Basically, I am telling you that I'm probably going to be buying this. Not probably, like I'm literally going to be buying this. I'm going to be re-adding JP Morgan Chase to the portfolio alongside Bank of America, potentially Wells Fargo. I'd have to really take a look. But my problem with Wells Fargo is they still have that asset cap. Now, while all that is happening at Wells Fargo, they are becoming a lot more efficient, which I really like. The CEO has really done a fantastic job. Of course, he's kind of fixing it from something that was detrimental, something terrible. So there was only up to go from there as far as the bank goes. And they still have a ways to go to kind of fix what they did. In terms of reputation for a bank, reputation is everything for the most part. So I'd really like to see that the bank, is able to kind of remedy that. But if we're let's actually plug in Morgan Stanley, for example, just to give another idea. So let's say and see. It's already set up for a bank, so we just have to wait for the numbers to update. But by the way, with Chase, JP Morgan Chase, it was a strong buy forecast by analysts, by the way. And same here with Morgan Stanley, strong buy forecast by analysts, $150 price target. Applying 101.14% upside. Of course, the model does not like it nearly as much. I just want to highlight that you should ignore the average growth of the past years. That has everything to do with this weird estimate that's coming in. So ignore that. And in terms of the cash flows, we are seeing, again, pretty lumpy. Shares outstanding, also kind of not as streamlined as I would want in terms of down and to the left, down and to the right. And yeah, all in all, a good investment bank, high quality, high caliber, really well run, just not at the price that I really like. I'd have to see a steeper discount for me personally. I don't know about you guys. You guys can comment down below what do you guys think. But yes, in fact, actually, I want to know, what do you guys think about the banking sector? Some people actually don't want to invest in banks whatsoever, and all power to you. Especially, I think that there's been a lot of scarring after the 2008 financial crisis. I personally prefer to invest in the primary dealers, making sure that they have that status for a variety of reasons. But, that's just my preference. I think that the United States has a lot of interesting buildup going on in terms of the smaller banking institutions that I really don't like, something that the stalwarts are going to be kind of immune from. And, as far as things are going, it doesn't appear as though some of them, not all of them, that some of them are going to be, too heavily exposed. I mean, we've been talking about, for example, subprime auto loans and how that might affect certain other banks. And something that we've talked about extensively in live streams. In fact, I talked about it in the Ally Bank video. Ally Bank has a huge portfolio exposed to auto loans. One thing I want to also highlight, tomorrow we are going to see another report from Wells Fargo. And remember that in the last earnings report, so about 3 months ago with Wells Fargo, we had a discussion about what that meant or how I felt about the housing market. Remember that Wells Fargo, of the big banks, is the most exposed to real estate. So under that context, or understanding that, we can get a bit of a taste of what is to come. Now, you need to also understand that the non-banking institutions are the ones that make up the most of the mortgage sector. So they actually are the most responsible for lending out mortgage loans. We do see Wells Fargo actually fell in sympathy, and a lot of people are now saying that potentially tomorrow we're going to see a red day. We're going to see disappointing results from Wells Fargo. I would actually expect that. I'm expecting that, but again, if we're surprised, then maybe the market reacts positively. But I'm kind of expecting more of the same, more pessimism in terms of where the drawdown is going to be, how the economy is doing. Again, of the big banks, they're going to be the most exposed. Bank of America, for example, is most exposed to energy. So they have a lot of loans to energies. You got to appreciate that when you kind of look into these banks. Some of them have different flavors in their portfolio, or they're more exposed to certain asset classes in their portfolio. And, with that being said, you get a different, strategy in some ways. But with Wells Fargo, I'm interested to see how they kind of talk about it. I'll probably make another video. Tomorrow's going to be the news video where we talk about all the things that happened this week, and it could be on anything. And then I'll probably also be talking about Wells Fargo, so keep an eye out on that. And I should be releasing episode 2 of the course. I'm debating on whether or not doing it on a kind of a QE course, talking about QE, what is QE, how it really works in terms of the accounting that goes on with it, because really there's not really that many good videos on it that I've seen. So and I'd love to have one here on Capital Mindset that I can refer to each time I discuss it. So with that being said, guys, thank you guys so much for watching, and I will see you guys on the next one. Bye.